Hello and welcome. Before we start, please make sure to subscribe to our YouTube channel for news and updates. Financial markets have been resilient in recent weeks, almost fully recovering from the swings experienced at the beginning of August. Major stock market indices are once again approaching all-time highs, with the S&P 500 gaining 19.2% year-to-date with dividends, less than half of 1% below its peak. This upward trend has been fueled by Fed Chair Powell's recent speech that laid the groundwork for a September rate cut. The past month is yet another reminder that market volatility is both natural and unavoidable. Rather than fixating on day-to-day market headlines, it's usually better to invest based on longer-run trends. Corporate earnings drive market returns in the long run. With market volatility subsiding for now, investors have shifted their attention back to fundamentals such as corporate earnings. Over the course of market cycles, the stock market tends to mirror the trajectory of corporate profits, rising as the economy grows. This is because shares of a stock represents an ownership claim on a company's profits. So, while markets can experience turbulence from time to time, a steadily growing economy and rising corporate profitability have historically fueled the stock market. This is clearly demonstrated in the accompanying chart, which shows that while markets and earnings do not move in perfect lockstep, they follow similar patterns. Over the past 12 months, S&P 500 earnings have risen to $232 per share, a healthy growth rate of 7.4%. This has accelerated with second quarter S&P 500 earnings rising at a blended growth rate of 10.9%, according to FactSet. If the final numbers don't change much, this will represent the fastest pace since the end of 2021. Companies are concerned about consumer spending. This is one reason companies are concerned about the financial health of consumers, especially given the economic swings and rapid inflation of the past few years. On their latest earnings calls, many companies cited worries about consumers being more budget-conscious with their decisions when it comes to restaurants, vacations, entertainment, and so on. This was echoed by executives from Marriott, McDonald's, Disney, and more. The accompanying chart shows that much of the extra money from each paycheck that households were able to save in 2020 and 2021 has already been spent. While this has not materially slowed consumer spending just yet, it is a factor that investors and economists have been following for some time. It's also clear that consumer sentiment is still poor due to the higher prices of the past few years. Consumer net worth is at record levels. At the same time, there are early signs that consumers' feelings about inflation are improving. A recent survey of consumer expectations from the Federal Reserve Bank of New York revealed a significant drop in consumers' expectations for inflation over the next 3 years, reaching a record low of 2.3% since the survey's inception in 2013. The University of Michigan survey also showed that consumers anticipate only 2.9% inflation over the next year and 3% over 5 years, a significant improvement in recent months. With inflation moving back toward 2%, the Fed poised to cut rates and markets rebounding, household net worth has reached new all-time highs. Over time, the growing value of financial assets could help to support consumer spending and sentiment as well. This is often referred to as the wealth effect, and when business cycles are in their expansionary stage, historically drives further growth. The bottom line? Markets are recovering from the swings experienced just a few weeks ago. Corporate earnings are growing at a healthy pace which supports markets in the long run. Investors should continue to follow these broader trends rather than short-term market swings. Thank you for listening. For additional information, please visit mraadvisory.com.